When people hear the phrase bull market, they often imagine easy money, soaring stock prices, and investors becoming wealthy without effort. But what exactly is a bull market? More importantly, how should everyday investors respond when one occurs? Understanding bull markets is important because they have historically been responsible for building the majority of long-term investor wealth. Welcome to Simply Speaking About Money. Our philosophy is simple: budget, save, invest, and when investing, focus on probabilities, not possibilities. In this video, we're going to explain what a bull market is, how bull markets begin, why they happen, and how smart investors take advantage of them without getting caught up in hype. Let's begin with a simple definition. A bull market is generally a period when stock prices rise 20% or more from recent lows and continue trending upward over an extended period. Bull markets are characterized by optimism, confidence, economic growth, and increasing investor participation. People feel more positive about the future. Businesses often grow. Employment may improve. Consumers tend to spend more money. As confidence grows, investors become more willing to buy stocks, which pushes prices higher. Bull markets don't start because someone rings a bell on Wall Street. Most bull markets begin quietly, while many investors are still nervous from the previous downturn. In fact, some of the strongest market rallies have started when public sentiment remained extremely pessimistic. This is one reason market timing is so difficult. Many investors wait for good news before investing again. By the time the good news arrives, a large portion of the recovery may already have occurred. Historically, some of the strongest market gains have occurred during the early stages of new bull markets. Missing those gains can significantly impact long-term investment results. Let's look at a common mistake investors make during bull markets. Many people assume that rising markets mean every investment will perform well. Unfortunately, that's not how investing works. Even during strong bull markets, some companies struggle, some sectors underperform, and some investments fail entirely. This is why diversification remains important regardless of market conditions. Bull markets can sometimes create overconfidence. Investors begin believing that markets will continue rising forever. Risky investments start appearing attractive. Speculation increases. Hype increases. Stories about easy wealth become more common. History shows that excessive optimism often appears near the later stages of bull markets. This doesn't mean investors should fear bull markets. It simply means investors should remain disciplined while participating in them. One of the most powerful strategies during a bull market is continuing regular investing. Dollar-cost averaging allows investors to keep buying consistently instead of trying to predict short-term market movements. This approach removes much of the emotional decision-making from investing. Another important lesson is avoiding performance chasing. Performance chasing occurs when investors buy investments simply because they have recently gone up dramatically. Many investors discover too late that yesterday's hottest investment can become tomorrow's biggest disappointment. Successful investors focus on long-term plans rather than short-term excitement. They understand that bull markets are opportunities to build wealth steadily, not opportunities to gamble. This is where our philosophy becomes important. Invest based on probabilities, not possibilities. Probabilities involve diversification, discipline, patience, and long-term thinking. Possibilities involve chasing hype, making emotional decisions, and hoping for extraordinary outcomes. Bull markets reward disciplined investors who continue following their plan even when excitement is everywhere. The goal is not getting rich quickly. The goal is building wealth consistently over time. Thank you for watching Simply Speaking About Money. In the next video, we'll explore what a bear market is, why bear markets occur, and how successful investors survive them without panic. If you want to see your entire financial life in one place, clarity is the first step. That's where Empower comes in. Empower gives you powerful tools to track your net worth, monitor investments, analyze fees, and plan for retirement, all in one dashboard. You can connect your accounts, see exactly where you stand, and make smarter decisions with real data, because what gets measured gets managed. If you're serious about organizing your money and building long-term wealth, check out the link in the description to explore Empower. Affiliate disclosure: I may earn a commission if you sign up using my link at no extra cost to you.